We had some all-time highs in the S&P 500 index in 2024. What usually happens after all-time highs? People might say, oh, recessions or the market drops. No, usually what happens after all-time highs is more all-time highs. It's very counterintuitive, but don't try to time the market. If you're lucky enough to be listening to this in 2024, get your money to work.
I see on the news that the market might go down. Look, it might, but like Spencer said, it's probably going to be another all-time high. That's very likely as well. But if it does go down, zoom out and look at the likelihood that it's going to continue to go up and to the right in growth over the next 30, 40 years for your retirement age. So your investing career is very, very likely the trend is up and to the right. So get that money in the market. Don't try to time the market.
Welcome to the Military Money Manual podcast, where every episode is all about achieving financial independence in the military faster than before. We believe personal finance shouldn't be boring or intimidating. Building wealth can be simple, and financial freedom is the ultimate financial goal. Now, here's your hosts, Spencer and Jamie.
Today on the podcast, we're covering the Boglehead way, the Boglehead investment principles. There's 10 investment principles, and you might be wondering, who is this Boglehead? Well, the Boglehead name comes from John C. Bogle, also known as Jack Bogle. He was born in 1929 and passed away in 2019, graduated from Princeton University. And his main claim to fame was he was the founder of the Vanguard Group. 1974, he founded the Vanguard Group, and he created the first index mutual funds for individual investors in 1976. And he was laughed at. People thought it was the craziest idea. Like, why would you want to buy every single stock in the stock market? Just buy the good ones. And why would you market cap weight it? I mean, it's just insane. But today, Vanguard has trillions of dollars in assets under management. He served as Vanguard's chairman and CEO to 1996. And he really pioneered the index revolution investment and drove down costs. So he's the reason why you can go to Fidelity now and you can buy ETFs and mutual funds from Fidelity that are indexed and are zero cost. They have zero expense ratio. Vanguard has very low expense ratios. Schwab also offers very low expense ratio funds. The TSP takes a very Bogleheads approach to investing. He believed in common sense investing. He wrote a great book called The Little Book of Common Sense Investing, which I highly recommend. He focused on long-term buy and hold strategies and advocated for broad market diversification rather than trying to beat the market. He's the guy who said it's better to be average and get the average market return than to be below average, the average retail investor is. He really transformed the mutual fund industry, and he saved investors billions of dollars in fees, possibly approaching trillions of dollars. And he created a loyal following of people who follow his investment people known as the Bogleheads. And so today we're going to go through the 10 principles of the Bogleheads. And Jamie, you'll start us off.
So principle number one is live below your means. We've talked about this many times on the podcast. It's the importance of spending less than you earn. So you can be very, very wealthy and you can make a lot of money and be very wealthy. But if you spend everything you earn, you're not going to be wealthy. You can make $1 million a year. If you spend $1 million a year, you are not wealthy. That's not how wealth works. It's about spending less than you earn, creating a budget or some kind of spending plan. And in order to do that, you need to distinguish between your needs and your wants. So what do I actually need in life versus what is a nice to have or a convenience item or something that is just, I want fast food, but I don't need fast food. So number one, live below your means, starting an intentional plan on how you're going to spend. Your income does not matter for Bogleheads. It's all about how much you spend.
Like our friend Jeremy Schneider from Personal Finance Club likes to say, spend less than you earn. Like that's principle number one. And same thing in the Bogleheads, spend less than you earn. You have to have that gap between what you spend and what you take in. And that's what you start saving. And that's what you can put to work and build wealth. Whether it's in real estate, whether it's in index funds like we'll talk about today, that's what you need to start doing is you have to have that gap. You can't spend every dollar you earn. You can't live paycheck to paycheck. You have to live below your means. Principle number one for the Bogleheads. Principle number two, develop a workable plan. There's plenty of goals out there that you can set. I know for me initially, it was, I just wanted to save $1 million. Like that, I didn't really know what I was going to do with $1 million, but it seemed like a nice round number and it seemed like a pretty far-fetched goal. And so that's what I started working towards. But if you set clear financial goals, and that can be financial independence, that can be 25 times your annual spend. That's the 4% rule, which once you've reached that number, then you can stop working or you can continue to work if you choose, but you know that you have that safety net that you can fall back on your assets. Create a basic financial plan. I mean, this is just as simple as having a budget and knowing that when your paycheck comes in, it's allocated and it's invested in the way that you want it to be. And in the military, that can be as simple as an automatic Vanguard Roth IRA deduction and maxing out your TSP every year. And then adjust your plan as your life circumstances change. So if you get married, you had a couple kids, maybe you need to buy some term life insurance, that's fine. But you just make sure that you continue to update your plan as you go through life and you stick to your plan. And we'll talk about that principle in just a little bit. So principle number 2, develop a workable plan.
Principle number 3 is never bear too much or too little risk. And so at first it's like, okay, what does that even mean? But really it's what is your individual risk tolerance for you and your spouse, if applicable? One spouse may be more risky or open to risk than the other. You need to balance your risk and potential returns though. Because if you see any fund or any stock that you look at or any prospectus, it's going to be usually the ones that have more risk or are the ones that have the greatest rewards. If you're looking at something very safe like bonds, it's probably not going to have the greatest rewards because there's no risk there. But I can't tell you to be more risky or less risky. You have to decide what that is for your situation. It's important to have an asset allocation of stocks versus bonds though. And there's a lot of options out there. Some people say 90% or 10%, 90% stocks, 10% bonds, 80%, 20%. And like we've talked about in past episodes on the TSP, for military service members in the thrift savings plan, your life cycle funds will automatically adjust this asset allocation for you based on your age and as you approach your expected retirement date, which is a nice concept. And if you don't know what to do with it, then maybe sticking with a life cycle fund is what makes sense. But this is an individual decision on how much risk you are willing to accept. But once you determine that, you need to have that plan that Spencer talked about in principle 2 to accept the right amount of risk to meet your goals.
Yeah, I like to think of this, Jamie, as if you're saving for retirement and you're 20 years old, the TSP used to default to the G fund, which doesn't have that great of return. You never lose your principal, but you're only getting 2 to 3% a year. It's basically just a little bit better than a bank account. And that's not going to allow you to meet your retirement goals. And that's why it's so important that you get your money into, let's say, a life cycle fund or 80% C fund, 20% S fund, whatever kind of strategy you come up with. But I think for most people, the life cycle funds are a great place to start because they adjust their risk based on your age until retirement. So if you're retiring sometime around 2065, just go into the L2065 fund and you know that you have a portfolio that's going to adjust the risk and become a little bit less risky as you approach retirement. But when you're in your early savings years, it's much more heavy in stocks and bonds. There's other rules of thumbs that you can use. Like you might have heard like 100 minus your age as the percentage to put into stocks and the rest in the bonds. Or if you're a little bit more risk, you'd like to take on risk, 120 minus your age to put into stocks. So if you're 20 years old, you could be at 100% in stocks. And for myself personally, I've been very heavy in equities my entire life because it's okay. I understand that the market's going to go up, the market's going to go down. You know, during COVID, it was tough seeing a 30% drop in my portfolio, but it came back and I had faith that it would come back. Never bear too much or too little risk. Principle number 4, invest early and often. Hey, it's Jeremy Schneider again from Personal Finance Club. This is his principle number 2, the power of compounding interest. You know, I can't remember who said it, but those who understand it benefit from it, and those who don't understand it suffer under it. Because they take on
sure
debt.
It was old Mili Shakespeare.
Yeah, probably. Abraham Lincoln. Compounding interest is the 8th wonder of the world. And like I remember when I was a kid and I saw those graphs and I was like, holy cow, if I invest like $50 a month from when I'm like 5 years old, I'll be a millionaire at like age 40 or whatever. And it never works exactly that way. I'll tell you what, like the numbers get crazy when you go back to like when you were born. And what if you had put $10,000 in an S&P 500 fund the year that you were born? How much would it be worth today? And the numbers are astounding. You're like, Mom, Dad, why didn't you put $10,000 in the stock market when I was born and then give it to me? Dollar cost averaging is another thing that can really help you too. So this is happening automatically. So if let's say you're contributing to your Vanguard Roth IRA, every month you put enough money in there. So by the end of the year, you're going to max it out. Then sometimes you're buying when the market's at a high. Sometimes you're buying when the market's dipped a little bit, but on average, you're getting your money into the market and you're going to dollar cost average the cost of your investments, and they're going to grow. They're going to grow over the years, over the decades. So by the time you get to retirement, you're going to have a nice nest egg. And I think the thing to notice here is invest early and often. Don't try to time the market. There's a great saying that it's time in the market, not timing the market, that produces the investment returns. We had some all-time highs in the S&P 500 index in 2024. What usually happens after all-time highs? People might say, oh, recessions or the market drops. No, usually what happens after all-time highs is more all-time highs. It's very counterintuitive, but don't try to time the market. If you're lucky enough to be listening to this in 2024, get your money to work, get it in there, start collecting those dividends, and get comfortable with putting your money to work into the stock market.
Yeah, the timing the market thing is tricky for people because sometimes people reach out and they have a lump sum, say they got a bonus or some kind of lump sum from inheritance or something. And they might have $50,000, $100,000 to invest. And they're like, what do I do? I see on the news that the market might go down. Look, it might, but like Spencer said, it's probably going to be another all-time high. That's very likely as well. But if it does go down, zoom out and look at the likelihood that it's going to continue to go up and to the right in growth over the next 30, 40 years for your retirement age. So your investing career is very, very likely the trend is up and to the right. So get that money in the market. Don't try to time the market. Principle number 5 is diversify. Diversification is important because you can't put all your eggs in one basket. And you've heard that saying all your life. You think of the people in the news that you heard about that had all of their savings at Enron or one of those companies that just like completely collapsed. All their employee benefits were in stock options. All their individual stocks were in the company, and then the company like goes belly up overnight. So in order to avoid having all your eggs in one basket, you buy a lot of things. So we're going to talk about index funds in a little bit, but when you buy something like an index fund, you get that built-in diversification. Same thing with a life cycle fund or a lot of the funds in the TSP, including the CNS. So you get a large pool of shares of stocks in one fund that you purchase. So you can diversify across asset classes as well as within your stock allocation. And then you also want to look at international diversification. So not all of your eggs in the US basket. We talk a lot about the bias that US investors feel towards the US economy. And the US economy is great. We love it. God bless America. But there is a lot of goodness in other international opportunities as well, even if the percentages don't look as great as they have for the US stock market recently. Be very careful if you don't have any international exposure and all is in the US. It'll help balance out the ups and the downs in the US economy.
There's a great chart out there that I'd love to look at, and it's comparing when international stocks outperform US stocks and when US stocks outperform international stocks. And we've been on the longest streak in the last, I think it's like 10 or 15 years since the 2008 global financial crisis. And the US stock market has crushed international stocks.
It's our whole adult life. It's all we've known.
Exactly. But there's this thing called reversion to the mean. And if you look at the global market cap, the US stock market usually bounces between 50 to 60% of the total global market cap. And international stocks, therefore, make up the other 40 to 50%. Some people say, well, US companies, they make a lot of their money overseas. And so you kind of capture that in the S&P 500. That's true. But I would be shocked if the US continues to crush the international markets the next 100 years. You don't think there's going to be any time period where you're going to be kicking yourself that you don't own international stocks? Maybe not. Warren Buffett says never bet against America. So I don't think I'm betting against America. I just think I'm diversifying and just making sure that if the US goes into a recession and the rest of the world doesn't, that my eggs are in different baskets.
We're not talking 50-50 US international that for either me or you as our personal strategies. Maybe 10, 15, 20%, sometimes 30% in some of the life cycle funds. It's definitely a minority, but as a portion of your portfolio likely should be in international options.
Just a quick note from one of our sponsors, and then we'll be right back to the show. Hey, Jamie, we got a lot of great people out there listening to the podcast. Any resources you'd like to point them to continue the education on financial independence in the military?
Yeah, if you're getting value out of this podcast, but you just want a little more detail or some more practical steps, you got to check out the Military Money Manual book by Spencer Reese, A Practical Guide to Financial Freedom. In here, Spencer laid out everything that he wished he had been told when he first joined the military, and it's going to help you build wealth and take advantage of your benefits while you're serving on active duty or in the reserves or in the Guard.
The Military Money Manual is available on Amazon, Audible, and my website, shop.militarymoneymanual.com in hardcover, paperback, ebook, Kindle, and audiobook. Podcast listeners are eligible for a special discount by using promo code PODCAST when you purchase the Military Money Manual on shop.militarymoneymanual.com. Principle number 6, invest with simplicity. So the Bogleheads have the lazy 3-fund portfolio. It's exactly how I construct my own portfolio. So all you need is 3 funds. You need US stock fund, you need a US bond fund, and you need some international stocks. In the Bogleheads, some people just do a third. So 33% into each fund, set it and forget it, maybe rebalance every couple of years, or if they get like super out of whack, then you sell your gainers and buy some of your losers. You can do this in the TSP. And if you look at the TSP, it's a great place to construct this portfolio. So you could do something as simple as 33% G fund, 33% C fund, and 33% I fund. Or if you want to sprinkle a little bit of S fund in there, you can go and figure out how you would do that. And if you don't want just G fund, you want some F fund, you could sprinkle that in as well. Or just to keep it simple, you could buy a life cycle fund, and then you basically get the full 3-fund portfolio construction that the Bogleheads preach. It's very easy to build a simple, effective portfolio. And if you have, let's say, a Vanguard, a Schwab, a Fidelity account, you can go in there. And like in mine, I have some VTI, Vanguard Total Stock Market Index Fund. So that's their ETF version of VTSAX, is also known as. And that's every publicly traded US stock. So you can gain access to the same thing in your TSP if you just buy the C fund and the S fund. Investing with simplicity. Some people overcomplicate it and they're like, oh, I want to be in this sector, or I want to be in this country, or I want to be in this. And it's like, why? What do you know that the total global market cap of all these people out there who do this for their full-time job, just because some crazy woman in a Facebook group told you to move all your money into the G fund or move all your money into the C fund, you don't have to listen to that. Like, you can just buy and hold. That's the Boglehead way. So invest with simplicity. Don't overcomplicate this. That's principle number 6.
So number 7 is using index funds when possible. And this is a way to make your investing very simple. So index funds, it's basically you buy this fund, like Spencer mentioned, like VTI, and you're buying thousands of companies. I think 3,800 companies, if I remember the number correctly.
Yeah, it's something about that.
You're buying a slice of Amazon, a slice of Microsoft, a slice of Delta, a slice of NVIDIA. Instead of putting all of your deposit into NVIDIA, you're buying an index fund that in this case is all of the US stock market, all publicly traded companies. There's other index funds out there, but it's basically you buy the one fund and there's a lot of options. There's a lot of stocks held in that one fund. The advantage of this is a very low cost way and you get a lot of exposure towards it. And oh, by the way, it's passive because you don't have to pick the winners. You pick all of them. So sometimes there'll be winners, sometimes there'll be losers, but you'll get all of them in your fund when you pick an index fund like that. When you are looking at active versus passive investing, it's a large debate and plenty of our listeners might not agree. Spencer and I definitely lean towards more of the passive investing strategy. And we default back to the principle of I'm fine being an average investor and taking the average stock market returns of better than 10% through the history of the US stock market versus trying to pick the winners and making sure. And even if I pay someone, I might get it, I might make good picks, but will I be able to repeat that year after year after year, decade after decade? Or do I just ride the passive investing index fund strategy and take the average into a wealthy retirement?
Yeah, Jamie, I think in the passive versus active debate, I think the data is quite clear. Only in the last 15 years, US large cap funds. So these are the funds that invest in the 500 largest companies in America. So they, instead of just buying the S&P 500, they go and they try to pick the winners, the stocks that they think are going to beat the market. In the last 15 years, only 12% of funds outperformed the S&P 500. Only 12%. So 88% of funds underperformed the S&P 500. So you would have been better off buying the S&P 500, just buying the index. And this is what just blows my mind is like, you don't know going into it that your fund, if you have an active fund manager, that they're going to beat the market or they're going to underperform the market. So you have to get it right at the beginning, and then you have to stick with them. So they might have like 2 or 3 bad years when you first invest with them, and you're like, I'm done with this guy, I'm moving on to something else. but then they could go on to have, huge gains for the next 12 years. So that's my thing, is that like I struggle to invest with any active manager because I'm like, what does this guy know? He doesn't know anything more than me. How are you guaranteeing that you're going to beat the index? And nobody can guarantee you that they're going to beat the index. So in that case, and just look at the data, in the last 15 years, only 12% of the funds outperformed the S&P 500. So I'm going to play my odds. I'm just going to buy the S&P 500. I'm not going to invest in any of these other funds that can't guarantee that they're going to outperform the S&P 500. One other thing I wanted to say is there was a study, 1926 to 2023, that looked at the 29,000 different companies that were traded in the US stock market. Of those 29,000, 50% had negative cumulative returns. So negative 100%, negative 90%, like they lost money. The 17 stocks generated cumulative returns greater than 5 million %. But that's only 17 stocks of 29,000. So what is that? 0.005%, like 5. The chance that you're going to pick, like what was the best performing stock of the last like 10 or 20 years? People are going to be like, oh, Nvidia or oh, this. No, it was Monster Energy.
Anyone in the military should have seen that.
I know, that's true. Yeah, we should have seen that one coming. But it just blows my mind that people think that they can outperform the index in the long run. In the short run, sure, go for it. Like everybody gets lucky once. But in the long run, and like the other thing that people say, oh, buy this stock or buy that stock, but they tell you when to buy it, but no one's ever quite clear when to sell it. That's the thing for me, is like, tell me to buy Nvidia 5 years ago, but when it doubles in price, like I'd be like, oh, cool, I'm out. Like triples, 10x. It's very rare that you can buy a stock that's going to 100x. And so instead of trying to pick stocks, which I think is a loser's game, just buy the index. And that's principle number 7. Use index funds when possible. Okay, principle number 8, keep costs low. So fees impact your long-term investments. There's tons of calculators out there where you can see how much of your returns get eaten by fees over the long run. But just know that like if you're paying over 1%, even if you're paying over 0.5%, you better have a really good reason, especially when there are absolutely free index funds at Fidelity. Schwab has funds that are less than 0.1%, less than 10 basis points. So does Vanguard. The TSP, the latest lifecycle fund, has a cumulative expense ratio of 0.05 or 5 basis points. That means you're keeping more of the returns in your pocket. If you're paying a fund manager, an active fund manager, 1%, they're taking all that money, whether you're making money or not. So now you have to overcome that hurdle, and it's a hard hurdle to overcome. So focus on expense ratios, keep your costs low, and that's principle number 8 for the Bogleheads.
Principle number 9 is minimizing your taxes. So having a tax-efficient strategy for your investment plan is important because you want to keep all the money that you can. You want to pay the government what you owe and nothing more. So how do you minimize taxes? Well, in the military, we have some great options because we have a lot of our allowances and a lot of our pay is tax advantage or tax-free. In retirement, you also have tax advantaged accounts. So we talk about Roth TSP and Roth IRA. When you invest in Roth accounts, you've already paid taxes on that money. So that money and all of the growth goes in tax-free. When you buy or sell a stock in Robinhood app or whatever, say you make $100 on a trade in Robinhood and you get lucky with that, well, you're going to owe taxes on that. And depending on how long you kept it is the rate at which it's taxed. But if you are making trades in a tax advantage retirement account, then it's not taxed either ever or not until you pull it out at retirement. So there's a lot of potential advantages there with doing things in tax advantage accounts like a retirement account. Another strategy that's a little more advanced and we won't get into in detail today is tax loss harvesting. So that's a way where you can offset a portion of your income by strategically selling some of your shares at a loss. So let's say I sell a fund at a loss of $3,000. Well, then I can claim that on my taxes as a tax loss. And then I effectively made $3,000 less in the IRS's mind that year. And sometimes you need expert help, maybe an hour with a CFP from hellonectarine.com, or maybe an hour with someone from the Military Financial Advisors Association who are military affiliated or veterans themselves, CFPs or financial advisors. You can take really good advantage of tax loss harvesting sometimes to help offset some of your income and be very strategic with that.
Okay, and the final principle, Jamie, principle number 10, stay the course. So Jack Bogle liked to say, Stay the course. No matter what happens, stick to your program. I've said stay the course 1,000 times and I've meant it every time. It's the most important single piece of investment wisdom I can give you. So I think this really gets to the heart of what the Bogleheads is about. It's not about day trading. It's not about active management. It's about coming up with a strategy, building a low-cost, automated, diversified, and simple investment strategy, and then being able to stick with it through the decades. That can be easier said than done, and I really struggle to see how putting all your money into cryptocurrency is a strategy that you can stick to, over the decades. But that's what some people are doing today. So part of staying the course is never trying to time the market. It's difficult to predict short-term market movements. The market just was at an all-time high a couple weeks ago. What happened? It dropped. But what happens usually with all-time highs? There was a study done by the Royal Bank of Canada, and 91% of the time, the S&P 500 did not finish the period down 10% or more. And over 5-year periods, the S&P 500 never finished the period down 10% or more. Investing during all-time highs can be scary, but it's try investing during all-time lows or recent lows. That can be scary as well. March 2020, the COVID pandemic, nobody knew what was going to happen. You need to be right twice, when to exit the market and then to re-enter. So I see it all the time where people are like, oh, I sold all my shares in 2021. And so I missed the 2022 stock market correction. And I'm like, oh, that's great. Have you gotten back in? They're like, nope. And I'm like, well, you just missed out on 20% gains last year, and you're going to miss out on, 15% gains this year. So come on back, jump back in. The water's fine. Missing your best days significantly reduces your returns. And investors often underperform their own investments due to poor timing. So just sticking with a plan, not selling, not moving to cash. Don't follow those stupid seasonal TSP investment strategies that you see on Facebook. You don't need that. You just need a buy and hold Boglehead strategy. And you need to be able to stick to your investment plan despite the market fluctuations, the market volatility, the media noise, your personal emotions. When the market's going down, Jamie, I just don't check it. I just don't care. When the market's going up, I love checking it because I'm like, oh, look at all this money I made. But when it's going down, I just ignore it. I just tune it out because I'm not invested for tomorrow or for 7 days from now or a month from now or a year from now. I'm invested for decades. My time horizon is decades from now, and I don't need to worry about it. So some things that you can do to stick to your plan, you can have a written investment policy statement. I've got an example on my website of one that I wrote. You can set an appropriate asset allocation based on your personal risk tolerance, avoid constant portfolio checking, rebalance periodically. If bonds went way down a couple of years ago, put some more money into bonds if bonds are part of your portfolio, but it reduces your costs and your stress when you're not checking it all the time. So those are the 10 principles of the Bogleheads way of investing, the Bogleheads investment strategy. Number 1, live below your means. Number 2, develop a workable plan. 3, never bear too much or too little risk. Number 4, invest early and often. Number 5, diversify. Number 6, invest with simplicity. Number 7, use index funds when possible. Number 8, keep costs low. Number 9, minimize taxes. Number 10, stay the course. I hope this was useful to you. And if it was, 5-star review on Spotify or Apple is the best way to say thanks. See you next time.
Thanks so much for tuning in to this episode of the Military Money Manual podcast. If you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This helps others find the show, and we really appreciate it. Thanks again for tuning in, and we'll catch you in the next episode.
The views and opinions presented here are those of the speakers and do not necessarily represent the views of the DoD or its components. Reference to any commercial products or services does not constitute DoD endorsement of those products or services.